Hello everyone, this is Riya from Nirmal Bang, the currency analyst. So let's look at the currency, especially the Indian rupee view for the coming days. The fundamental factors that are playing right now for the rupee is definitely the US bond yield, the pound fluctuation, as well as what has happened with the GDP numbers that have recently been published. So let's look at the US bond yield. Now the US 10-year bond yield rose above 1% for the first time since March and has been maintaining that hold for now. So why is this a concern for the Indian rupee? Because this will have an impact on the Indian rupee directly. Now the rising yield is anticipated as an activity pickup amid the widespread COVID-19 and there is an increase in the consumer spending into the US economy. So this will lead to the economic growth of around 4.5% to 5% for the US economy. That's what has been anticipated. And obviously the yields rise. If there is no intervention from the Fed and the Fed keeps the borrowing cost ultra low, throughout the pandemic recovery, this will support the economy and will also uphold the employment and the inflation issues that the US is facing right now. So the employment numbers will improvise, the inflation will come into the picture for the US as the economy starts to grow and there is the activity pick up, the spending gets pick up and so forth. So the inflation and so forth go hand in hand for the US economy. Now, obviously, the dollar index is also, revised from its lower lows that it has seen in the recent days because of the, as the Democrats won the Georgia Senate election. So what happened here is this will boost the fiscal stimulus more because already the Congress was controlling as to what amount of fiscal stimulus will be put into the economy, and since there is no the sign of the infusion that has happened into the economy and so forth, there is an anticipation that the whole fiscal package for the US may be revised a bit. Right now it is at $2,000 per American citizen. So that is another role that will be playing on for the dollar altogether. So whenever there is a yield rise in the developed economy, obviously there is an attraction that the market gets in order to invest the money. So this is how it will be, affecting the Indian rupee because Indian rupee has been an underperformer for the Asian peers in the past few weeks. And the key factor that determines the attractiveness of any carry trade of the currency is the yields that the country gives to the investors and the market. So the key factor to determine the attractiveness of a carry trade of the currency will be speed up at which the US yields perform, and if it's pushed higher as they should be in anticipation of the overall rollout of the vaccine and so forth, it will definitely weigh on Indian rupee as well. Also, the another factor that is playing out for the Indian rupee is the annual contraction. The numbers that has been published by the Statistics Ministry recently, this shows that the overall GDP may contract by 7.7% in the financial year ending March 21, which is steeper than what the RBI anticipated for the overall economy, which was at 7.5%. So this sharp revision into the GDP is likely to cause a disruption as to the overall outlook and the sentiment of the market. The GDP 7.7% contraction is made on the fact that there will the overall pandemic, the lockdown measures and the steps taken to battle the whole pandemic is still was not sufficient for the overall Indian economy, and it will definitely weigh on the Indian economy because the market it's still not fully, open for the overall activity to get performed. So, apart from these few sectors, more that have been opened up, the major uh, sectors are still under the COVID-19 impact, and I think this will weigh into the overall economy numbers as well. And going forward, I think the financial numbers will be quite disappointing for the year ending March 21. So despite one of the quickest COVID-19 lockdowns, India is still the world's second highest infection. So this has kept the government from fully reopening the economy, which will definitely weigh onto the overall economic numbers and the strength of the Indian rupee. So going forward, I think you should definitely go the strategy that should be followed for the Indian rupee would be to buy on the dip, because I think if you look even at the trade deficit numbers, trade is not very attractive. It has widened even for the present quarter numbers that have been published. Both numbers are good, but there is a slide of another percent into the export numbers. So I think there will be a lot of intervention that will be there from the RBI. Recently, there is the OMO operations that will be held from the buyer from of around 100 billion into the RBI bond. So the bond yield is likely to go up a little, and this will also directly reflect into the rupee strength as well. Going forward, I think RBI and the government wants to promote the export activity, and thus there will be an intervention into the Indian rupee going forward. So I think the range that is that the Indian rupee will remain at least for a few months will be between 70 to 80, 73, 75. So the strategy that one can definitely go forward for the rupee is to buy on dip. The best level to buy on dip is around 73.11 and 70 to 95, which comes to into this level. Maintain a strict SL of around 72, 75 for a target of 73.50, 73.75. Going forward with the strategy, I think 73.45 is a very important support on a shorter term. If it breaches the same, I think rupees can test 73.33, 73.11 momentarily, and one can go short. But this is a very short-term strategy of going short into the rupee. For a longer term, maintain a buy on dips around 73.11, 70 to 95 for the rupee in the coming session. Thanks for listening. Stay home, stay safe.